In this video, I show you how to master trend lines, what they are, how to use them, and yeah, how to use them for your trading. So let's get into it. So Trendline 101, what are trend lines and how do you use them? So trend lines, as the name suggests, they are used to describe market trends. They help you to read the strength of a market. So is a trend losing strength, is it gaining strength, or is it a stable trend? It will also help you to understand when trends are turning. So when the uptrend is over and it's likely to reverse into a downwards trend and yeah, reverse. Pullback trading, and it can also be used for breakout trading, as we will see. So first of all, when it comes to drawing trend lines, the general idea is that we draw those vertical or diagonal trend lines, and we connect low points in a downtrend, and we connect the high points in an uptrend in a downtrend, as we will see in a moment. And the general idea is that you need at least 3 touch points. You can always combine, you can always connect any 2 random lines on your charts, but only if you have a third touch point, then you have a confirmed trend line. And usually trend lines don't have more than 4 or 5 touch points usually, as we will see shortly. So 3 to 4 touch points, that's usually what you have on an average trend line. Why that is, we will see in a moment. And here you can see that again. So in an uptrend, we connect the lows of a trending market, the so-called swing lows. And when the market is going down, we connect the swing highs. There are many different other ways how you could do that. This is generally how I like to do it because it immediately tells you about trend strength. And when a trend line is broken, where I marked those red circles, so in this case, the market was moving up, then here was then the breakout or the break below a trend line, and then the uptrend was over and the market reversed. The same happened here. The market was in a downtrend. Then here the price broke the trend line to the upside and it started an uptrend, and so on and so forth. The biggest myth when it comes to trend lines is that the more touch points, the better. And there is something called order absorption, and this happens each time the market hits, whether it is a trend line or a support and resistance level, it actually gets weakened because it is becoming more and more obvious. And if everyone is trying to profit and trade the same trend line in the same way, it becomes harder and harder because there's front running, there's fake outs. So as I said in the first slide, 3 to 4, maximum 5 touch points afterwards, you should be really, really careful. And then also the trend lines tend to break more easily. One great thing about trend lines is the angle, because the angle really tells you a lot about the trend strength. So when we start here and we connect the lows of this uptrend, we can see this is a 26 degree, which is a fairly moderate trend strength. Here, on the other hand, when we have a longer trend that is lasting longer, we get often more than one trend line that can describe the trend. Here you can see we start out with a 50 degree drop. Here obviously at the beginning it was much stronger and a much steeper angle, but here we have a 50 degree and then it changes to a 21 degree, and you can already see that the speed of the trend is decreasing significantly, is more than halving. So from 50 to 21, it is a significant change in the price strength and how the price drops. So you can already see that the trend is losing strength. And then even here at the bottom, you can see we more or less only make a double bottom and the price is not able to fall any lower. So the angle is always very, very important. And I will show you in the end of the video how to draw the trend lines using TradingView, which is here what I have, and how to turn on and off the angles. Here another example. So we have a few trend lines. The market starts moderately with a 19 degree price trend strength, and you can see there are often more than one way to draw trend lines. And what I usually recommend is that you should just use the trend line that has the most confluence, which means that is respected the most. But of course, it always goes only until a certain point. So if you have 4 or 5 touch points, I would be really, really careful. So here we're starting with a moderate trend. The price or the trend is just starting. Then it's accelerating to 39, to 55, and then 57. So in the previous sample or example, I showed you that when an angle is losing strength, it can show you that the market is losing strength. So the angle, if it decreases, it should be a heads up. Of course, you're not going to trade this blindly. You're always going to wait for the actual breakout. On the other hand, when an angle is increasing significantly, this can also point towards a very, very important market pattern, which is called actually the bump and run pattern. And it means that you have a normal trend, then the bump starts when the market is suddenly increasing significantly. It's a parabolic trend often. And then, as we say in technical analysis, the trend becomes unsustainable. And then at one point, when there are no more buyers left because the price has accelerated so much, it's just unattractive for buyers to get into a trade or into a trend that is shooting up so high and that is already that high. Then you will often see profit taking, and then the trend reverses. So if you see a very, very parabolic trend, then this should also be a heads up. And the trend lines tell you when that is the case. Here we have one of the biggest problems of trend lines is that they can be very, very subjective. With support and resistance, we can rule out and we can eliminate some of the subjectivity because it's just a horizontal flat line. But with trend lines, it can be more subjective. Do you use the wicks or just the closes? Maybe here, is this good? Is it bad if the market cuts through a trend line? So there are lots of parameters that are more subjective. And to overcome that, what I usually recommend is that instead of purely waiting for the break of a trend line, what often also happens is that when a trend line is broken, as you can see here, the market is also changing its trend structure based on the Dow theory. If you remember, the Dow theory says that during a trend, the market makes higher highs and higher lows. That is the definition of the Dow theory. And with a trend line, we can describe such a trend very nicely. And then once a trend line is broken, we can often see that the market is also breaking and violating this Dow theory. So here you can see the market broke the trend line, where I marked it with an X, and at the same time, the price also made a lower low. So here was a previous swing low, and then the market broke it, and this is then a much, much more robust and more objective way of looking at trend lines. Here are a few more examples. You can see I drew a trend line here to the upside, I drew a trend line here, and here, and here. And each time a trend line is broken, you can see that here the X, where this trend line was broken, the market also broke a horizontal level here, here as well. The price broke this downward trend line, and it also made a higher high at this point. So two confluence factors together, and the more confluence factors you have, the better it usually is, and the more robust your signals. Then here the market has an upwards trend line, we have a low, the price breaks it, and so on and so forth. So combining trend lines with support and resistance or just local highs and lows can improve the quality of your price analysis significantly. The trend lines are often the cornerstone and the foundation of many different of the general price pattern. So here we can see we have something like a wedge. You can see we have a trend line that describes the price to the downs or from the downside, and then we also have a trend line here at the top that we can draw. And you can see already, first thing, that the price action is narrowing and narrowing, so the swings are becoming smaller and smaller. At the same time, we can see here with the trend line to the upside, this is a very, very shallow trend line, of course. And what this means is that the price is not able to push higher as easily anymore. So from here to here to here to here, the price is barely able to push higher. So this should already be a warning signal that the market is not, or that the buyers are not as interested anymore. There may be more sellers coming into the market who are pushing the price down earlier and earlier. And then here, once the trend line is broken, we also have a violation of a previous low point, and then the market turns around. So it really pays off to know about trend lines because they build a foundation for many of our regular trading patterns. Here as well we have a wedge pattern with a failed breakout, and if you can put together all of those things, we have a trend line. Then here the trend line to the downside shows us that here the market was in a very strong trend. The price was able to fall very quickly, and then here with this trend line we can see that the market had issues. It was not able to make lower lows as easily anymore. And then here we have a failed breakout, a very important spike, and then the final piece to the puzzle is here the market breaks a previous high point and now makes a higher high, and we have three things coming together here nicely. Of course, we can also use trend lines to describe continuations or consolidations. Here the market was in a downtrend, then here we have a small consolidation described by this channel with the trend lines, and once the trend line is broken with the support and resistance here, then the market can resume its downtrend. Also very important when you look at corrective and impulsive waves. So here the trend wave is very strong. The market was able to fall very quickly in a short period of time. During the consolidation, the market was not able to rise as easily. So we can see, okay, strong downtrend, very weak consolidation. So not as many buyers here. And then it is more likely that we'll see a reversal or a continuation to the downside here actually, than it is that we see a full reversal to the upside. So we can put those things together and really come up with a very sophisticated way of analyzing price with just a few tools and a few concepts. So now we are in TradingView, and let me show you how to use the Trendline tool in action. In TradingView, let me actually move this into the frame. Here on the left hand side you have your toolbar, and here we have our trend lines. When you open it, it is right here. You can also use info trendline or trendline angles, which is interesting. So let me use this one, and then I will just change the color. And then we look for, okay, whenever you see a trend, look at the highs. Not always will you be able to draw a trend line. That is okay. We have many different tools in our toolbox that we can choose from. So let's see if we can combine this one and this one and this one. And we almost get a perfect trend line. Okay, and then here, when you double click on this trend line, you can open the setting box, and in styles you can change the text color, the size, and then you can see here you have many options here. And then you can see, okay, this is a 30 degree trend line. Then we can draw another one, maybe at the bottom, so you can see very shallow. And now again we have constructed our wedge triangle pattern. And to the upside we can probably do that again. You can see, let's start here, very strong trend with 59 degrees. By the way, there's a tip here. You can click on this one and then you will stay in drawing mode, so you don't have to always reselect the trend line tool. And then here you can see we have another trend line, 28 degrees, which is roughly half. And then at the top you can see the market completely rolls over, and this was already indicated by your trend lines. In TradingView, you can even make an alarm on your trend lines when you right click on them, and then you just click add alert on the trend line, and then you have a few settings that you can use, and then you just, when you hit create, it will create an alarm, and you can see that here indicated by this little alarm icon, and whenever price will cross this trend line, you will just get a notification on your TradingView, and that's then how you can use it going forward.